Ladies and gentlemen, the S&P 500 just made a new all-time high. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks climbed just points away from record highs on Thursday as the major indices continued their ferocious rally led by what was pretty much just the mega caps. You can see here semiconductors led the way, AVGO up 2%, Nvidia up 0.5 percentage point, Google and Meta also gained, both up in excess of 1%. Netflix, Disney and entertainment in the fold as well. Amazon was up 2% and Microsoft up 1% with Oracle and Palantir adding to that as well. We did see a couple of names weigh on the overall space. Apple, Tesla and Walmart did weigh on the market. All in all, it was a green day across the board. There were only two sectors that didn't gain today, and that was staples and real estate. And these are largely relatively small sectors in the grand scheme of things, with the S&P 500 up 0.75%, led by energy, communication services, industrials, discretionary, technology, financials. These were all green sectors, and you could see here the day off in the green, and we sort of just drifted upwardly, making an all-time high on a wick basis, but not a closing basis for the S&P 500. Very, very solid stuff. And the truth of the matter is large caps didn't lead today. It was small caps followed by mid caps and then large caps. Still green, but actually being the worst performing factor segment or size segment today. Small caps all gained in excess of 1%, very bullish price action. Mid caps followed suit and then large caps. And today's price action stemmed off a couple of things. Number one, we got a lot of trade news. Trump came out and trade deadlines for the 9th of July are not critical for countries to strike trade deals, and pretty much Donald Trump and his team are kicking the can down the road. Countries had 90 days to negotiate with Trump, and if they are negotiating in good faith, Trump will extend those deadlines further. We also got some more trade news from India. This happened before the open. Now, US-India trade talks are currently facing a roadblock ahead of tariff deadlines, just because there are some disagreements with regards for auto components, steel, as well as farm goods. So hopefully this gets ironed out in the next couple of days. But the big one we've all been waiting for after the bell today, Donald Trump came out and said a trade deal with China was signed yesterday.
Jameson, everybody wants to make a deal and have a part of it, right? I know you and Howard and Scott are working overtime, making deals with other countries. Remember a few months ago, the press was saying, do you really have anybody of any interest? Well, we just signed with China yesterday, right? Just signed with China. We have everybody. We're not going to make deals with everybody. Some we're just going to send them a letter, say, thank you very much. You're going to pay 25, 35, 45%. That's the easy way to do it. And my people don't want to do it that way. They want to do some of it, but they want to make more deals than I would do. But we're having some great deals. We have one coming up, maybe with India, very big one, where we're going to open up India.
And then what also moved the market today was some of the data points we got. We actually got some fairly good data, especially when you look at durable goods orders. That came in at 16.4%, doubling the consensus. However, the GDP growth rate actually came in at 0.5% versus the consensus of 0.2%. So there's that. Growth came in a little bit worse than expected, but it looks like the market sort of just looked through it, because when you look at corporate profits, even though we did see negative 3.3%, we actually beat the consensus of negative 3.6%. The GDP price index came in at 3.8% versus the consensus of 3.8%. And I think that's why we actually looked past the overall final growth rate. And then initial jobless claims ticked down to 236,000. We were getting a little bit crazy here, close to the 250 mark over the last couple of weeks, but it looks like that has tempered down. Really, really good to see that. And ultimately, that's what the market is looking at right now. We're looking at inflation, and we get inflation data tomorrow, as well as the labor market, because the market's sort of looking through some of the growth numbers we got here, mostly due to tariffs and the overhang from tariffs. So all in all, very solid data, and the data points that needed to Shine did today. Looking at some other market movers, Micron Technologies was down 1.19% after its earnings. Now, this company put out great earnings. It was a double beat and raise. The stock's still down. I have a full update on my channel right here on Micron. Go ahead and watch it. We talk about, is Micron a buy right now? Because its valuation is very, very attractive, but it is losing market share and there is some competitive dynamics you do need to be aware of. So go ahead, watch that video on my second channel, FinFluential Media. I'll leave it in the comment section below. Nike reported its earnings after the bell. Now, this is going to be the next video on the channel in the next couple of hours. Nike was up 2.81% today, but fell 0.72% after its earnings, which beat on the top line, beat on the bottom line. The company is still transitioning and struggling, but it does look like we probably are forming a bottom in at the moment for Nike. And we're going to discuss everything again on the FinFluential Media channel. So go ahead, follow me there, like and subscribe, and we're going to talk about Nike and their latest earnings report. And then Hims and Hers Health was up 11%, absolutely rallying off the lows. Now, the stock is down about 20-25% for the week, but you simply cannot keep this name down. And then another name that was down today was General Mills. Now, this pertains to the consumer, and they had a very ugly quarter. They saw category and margin weakness, and General Mills expect more of the same this year. It seems that it's getting harder to take pricing, volume is still weak, and inevitably margins are imploding. So there are still some concerns in the market, particularly for the consumer. But then when you look at other sectors and other industries, they're not showing the same. So consumer dynamics are always very hard to predict. But for everything we saw today, there were 4,500 advances, 1,800 decliners. We saw net inflows in the New York Stock Exchange, outflows in the Nasdaq 100, S&P 500 gaining 0.8% today. And then market momentum, while we haven't been able to take the 150 and 200 day, still looking very, very solid in the shorter term and medium-term averages. Now, guys, looking at the charts, you can see the S&P 500, the Nasdaq 100, large caps, very positive day, but the real outperformer came from the IWM, up 1.62% today, and mid-caps, S&P 600 also outperformed. That's mid-caps and profitable small caps. The RXP, very good day across the board. You could see a growth outperformed value, but value is still up 0.56%. You take those gains any day where you can. European stocks were flat. Israel stocks were up. Middle Eastern stocks, the SX200 was up 1%. Solid day across the board. Guys, I really like the Israel ETF. I like this ETF. It's a lot of tech and defense companies, cybersecurity companies. And then Chinese stocks today were down 0.26%. Volatility fell, yields fell, the dollar fell as a result, bonds gained. Bitcoin was down 0.2%. Flat, in other words. Ethereum was flat, gold was flat, silver was flat as well, just the commodity space flat. And what we really saw was just a rotation into equities from, stuff like oil, silver, gold, Bitcoin. A little bit of rotation into equities, particularly small caps, higher beta. But let's talk about the S&P 600. Guys, you can see that we are at the top end of the range right here. We hit the core wall right here, and we are a stone's throw away from all-time high. That was the all-time highs. We made an all-time intraday high, not a closing high, unfortunately, but look, very strong momentum. You can clearly see the momentum up here. Now, normally what happens when we get to the top end of the range and we don't get the core wall moving up, we tend to see a little bit of downside. So what that means is we probably could see a little bit of de-risking, but I expect that de-risking and that pullback to be very, very shallow, right? And for us to go ahead and retake those all-time highs. I actually wouldn't be surprised to probably go see like an intraday all-time high tomorrow, maybe like some form of a gap up. We go ahead, a gap up, and then see a little bit of de-risking into the weekend. But it does look like we are going to get maybe an India deal announced. We're going to get the details of a China trade deal. All of these trade deals are probably the next move that's going to take us higher. Then after that, we get earnings. And then after that, we get rate cuts coupled with maybe some good economic data that could really propel stocks higher. But talking about economic data, tomorrow, what could really move the market is PCE. We get the personal consumption expenditures. Guys, if we get a hot print, right, we could definitely see a little bit of a pullback here in the market. So do be aware that the market will also move tomorrow on the PCE. But let's say if those numbers come in line, the market's going to continue to do what it has been doing. And that is momentum to the upside. Any dips we do get, buy those because we will be going higher. This is insanely bullish here in the S&P 500. This is incredibly bullish price action. And look, on a year-to-date basis, we are only up like 4% for the year. But of these lows, it has been an incredible experience. Now, the Nasdaq 100, very similar situation, a bit above the core wall right here. That's a new all-time high for the Nasdaq 100. Guys, you want to know something absolutely crazy? If you exclude Apple from the Nasdaq 100, it would be 700 basis points higher. I'll show you what I mean. Here is the year to date of the tech sector X Apple, and Apple as a result. So you can see that the technology sector, which is the XLK, is only up about 1% year to date, right? Apple is actually down 20% year to date. It hasn't recovered off these lows right here. This is indexed to 100 at the start of the year. So Apple being at 80 means it's down about 20% year to date. But the technology sector, excluding Apple, is actually up 108, so 8% year to date. And you can see that 700 basis points of outperformance between the two, right? So Apple as a whole is holding the tech sector back. But something else I want to show you guys right here. This is decomposing year to date returns. And something very interesting about the tech space, right? If you go ahead, look at the price change year to date, the forward PE change, and then the forward EPS change. And then the sum of these two will equal if the market has gotten cheaper or more expensive. When you look at the tech sector, right, up 3% year to date, earnings per share has actually increased 4%. In other words, compared to the start of the year, the tech sector has actually got about 1% cheaper. That is actually true for the discretionary space right here, down 5%, forward EPS only down 1%. And that is why, the XLY is actually cheaper relative to the start of the year. And that is also playing out in the healthcare space. Not so much in the comm services, slightly more expensive, but that's because earnings have grown 3.76%. Places where you don't really want to be that have gotten super expensive, right, is stuff like energy, staples, materials, and real estate. So a lot of the rally we're seeing right here has actually been multiple expansion because either earnings have fallen or have not grown as much as the price has grown. For example, real estate up 3%, forward earnings down 1%. That means it is 4% more expensive at the start of the year. So look, buying tech at the moment, you're actually buying a relatively cheaper stock, but on an absolute basis, it is the most expensive sector in the market. However, you're buying the highest quality companies, and that has never been a bad idea. Had you bought the Nasdaq 100 at any point in the last 5 years, you would be up on your position because we just closed at a new all-time high for the Nasdaq 100. Now, guys, with the RTY, I think small caps are set to outperform. I think they're going to outperform in the month of July. I'm not talking major outperformance, and that is because they have underperformed this year, but we should see a catch-up trade, especially if we get, especially if the economic data continues to be very robust and we get rate cuts in July. I don't think we're going to get a rate cut in July, but, anything is possible right now. Guys, looking at European stocks, we continue to see consolidation just above this 527 area. This is where I want to be a buyer, looking for those all-time high in European stocks. I like the Israeli ETF. Any dips I do want to be a buyer of. I don't have a position just yet. Looking at the 10-year yield, it continues to fall in this daily downtrend. We're officially breaking below some of these very, very key levels. If we go ahead, get to this 4.2% level, it can then open up, levels below the 4% area right here. So very interesting position to see where we are right now in the 10-year yield. The dollar keeps falling like a rock. It does look like we are putting in lower lows right here. I am still bullish on the dollar, but probably only after the July 4th, once we get that reconciliation bill, then we should see the dollar improve markedly. TLT, let's quickly look at bonds. Yeah, coming off these lows at the $83 to $87 mark. And if yields continue to fall, the TLT will continue to do very, very well. And in Bitcoin, you guys know that we are bullish on Bitcoin. M2 money supply continues to help us move higher. So be long Bitcoin. Any pullbacks we do get, you just want to add exposure. This is a volatile asset, but look, very, very bullish. And I do think we are going to continue to take all-time highs, especially because we have done so in the Nasdaq 100. Guys, we are in a risk-on environment, and you want to be holding risk assets. Stocks that I do really like, guys. Yesterday, I said you want to get into Hims & Hers Health, looking for a massive move, potentially closing this gap. Hims & Hers was actually up 11% today. Very, very strong, barely down here in the after hours. I think we are probably still going to see a little bit of consolidation in this area right here, and then we'll make our next move to the upside closer to those earnings. But guys, do be aware that there is still quite a bit of risk in this name, litigation risk and a whole bunch of other stuff. So maybe if we do get a pullback, maybe to this mid 40 area, low 40s area, that's where you can enter, maybe enter in multiple tranches with this name. Another stock that I do like, EVVTY, Evolution AB. We're looking to close this gap right here. Now the stock was kind of flat today, but it's up 3% for the week. Very, very solid. I do think we are going higher. It trades at 10 times earnings. And guys, diving into sentiment, this is the AAI sentiment survey, and investor sentiment continues to remain cautious, with bearish sentiment outnumbering bullish sentiment for the fourth straight week. This pessimism may act as a contrarian indicator suggesting underlying bullish potential if the market fundamentals continue to remain strong. And we simply can't fault the fundamentals here for Q2. We're looking at earnings growth of 13.6%, revenue growth of 5%, led by healthcare, comm services, tech, and industrials. Margins very robust, double digits, and we've absolutely smashed the estimates coming into this earnings season. In some cases, almost doubling it. And if you exclude energy, more than doubling the consensus estimate. Very, very strong results. And when we look at the technicals, especially seasonality, guys, we're heading into the first week of July. And normally the median 2-week returns for the S&P 500 in the first week of July is the best on record. We get just under 2% gains. This is what the seasonality normally looks like. So you can see we're looking for very robust returns up until about the 13th or 14th trading day. Then we're looking for returns that could be sideways in momentum. And then when we actually have a look at the second half of July, we can see that the returns are less than spectacular compared to the first half of July right here. So for all intents and purposes, guys, you want to remain long in the month of July, because even though we do see a bit of consolidation in the back half here, we tend to see a very, very strong month with an average return in excess of 1.5%. Now, guys, we're going to talk about the macro. I only have one thing for you today. And this was the note we got out of Morgan Stanley, and they project that the Federal Reserve will implement 7 rate cuts in 2026. The reductions are expected to commence in March, ultimately bringing the federal funds rate down to a range of 2.5 to 2.75. Crazy bullish. This is why you want to hold equities into 2025-26. Rate cuts are generally very, very bullish for risk assets, especially when you look at the economic projections. Even though they do see, inflation ticking up and growth slowing, they don't see the macro falling apart or anything. So for all intents and purposes, the Fed will be cutting into what is a robust economy, and as it is right now, a robust equity market. And that normally means stocks go higher. Now, diving into the data, tomorrow we have some very key inflation data. So we get PCE and core PCE, personal consumption index. That's just the Fed's preferred gauge of inflation. We also get personal income outlays, personal income and personal spending month over month, year over year. Now for core PCE, the expectation here is for 0.1. For headline PCE month over month, we're looking for 0.1 as well. That's a gain from the month prior. And then the PCE price index year over year, we're looking for a 2.3% print. Now the forecast here has it for 2.2%. So if we get anything in this range, it's going to be very, very bullish, but we are seeing a slight uptick because the previous number was 2.1%. Very interesting to see that. For personal income and personal spending, we're actually looking for a 0.3 and 0.1 respectively there for those figures. We also get University of Michigan consumer sentiment, and then we also have a couple of Fed speakers. In terms of data tomorrow, we don't really have much of anything, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.